All right, picture this. Trillions of dollars just vanishing from traditional bank accounts. Sounds crazy, right? But that is exactly what might happen because of Elon Musk's ambitious new financial platform. Welcome to this explainer, where we're going to map out exactly what X money means for your wallet, the banking sector, and honestly, the broader economy. Let's dive right in.
Let's kick things off with a pretty frustrating reality. Right now, as we speak, the average American savings account pays a dismal, practically non-existent 0.38% interest. When you factor in inflation, keeping your money in one of these standard accounts effectively means you are losing purchasing power every single day. It's a massive wealth drain just hidden in plain sight.
So why on earth do we put up with it? Well, traditional banks have thrived for years on this concept of customer inertia. Basically, they rely heavily on your reluctance to switch. Ordering new checks, relinking your automatic bill payments, updating your direct deposit with your employer, it's a huge time-consuming hassle. Because of this built-in friction, banks know consumer deposits are incredibly sticky. And, more importantly, incredibly cheap for them to hold. They borrow your money for absolute pennies and lend it out for a fortune.
Which brings us to part one of our breakdown. Enter Elon Musk's X money. To disrupt a massive system like this, you really got to cut the fat. Think about your traditional bank for a second. They are saddled with massive overhead. We're talking physical branches on every quarter, those expensive marble lobbies, thousands of tellers. X money, on the flip side, operates purely on code. They have 0 physical branches and a massive, pre-existing, built-in user base of 600 million people on the social media platform. By completely eliminating all that physical overhead, they are able to pass those incredible margin savings directly onto you.
And the perks they're throwing around to get your attention? They are honestly pretty wild. Most notably, they are teasing a massive 6% annual yield on savings. That is roughly 15 times what traditional banks pay. Add in 3% cashback on purchases, instant peer-to-peer transfers, and a premium laser-etched metal Visa debit card just to make you feel like a VIP. It's an incredibly powerful marketing headline designed specifically to break that customer inertia we were just talking about.
But listen, this isn't just some fun side project for X. Musk actually envisions this becoming the central hub for, well, literally every monetary transaction you make. He wants every paycheck, every transfer, and every single bill you pay to live entirely inside his app. He is essentially aiming a loaded gun at every traditional bank in the country by trying to monopolize all of your financial activity.
Okay, so part 2, reading the fine print. Because to really get a handle on this, we need to look under the hood. First off, let's put that flashy 6% rate into a bit of context. Sure, 6% sounds absolutely incredible when you compare it to the 0.38% you get at the big banks, but actually scratch that. It's really only slightly higher than standard online high-yield savings accounts, which currently pay between 4% and 4.5% anyway. The 6% is a fantastic rate for sure, but it is primarily acting as a flashy marketing hook. Furthermore, to actually access that top headline rate, it's very likely that you're going to have to jump through some pretty significant hoops. For instance, you might be required to route your entire paycheck via direct deposit straight into the platform. It's a classic strategy, right? To get the big reward, you have to hand over total control of your cash flow. Plus, we have to consider that at the time of gathering this data, the basic rulebook hasn't even been fully published yet. You're dealing with a variable rate that could drop at any time. And perhaps most concerning of all, you'd be trusting your life savings to an app famously known for customer service that acts like a total black hole. I mean, if something goes wrong with your rent money, who exactly are you calling? You can't just tweet at Elon and expect a refund.
Let's pan out a bit for part 3, systemic risks to Main Street.
There is a massive ripple effect we need to talk about here. When millions of users suddenly migrate their funds over to high-yield apps, local community banks lose their cheap funding pretty much overnight. And the direct consequence? Those local banks are forced to pull back on lending. This means restricted mortgages for first-time homebuyers and way tighter lines of credit for local small businesses that desperately rely on that capital to stay afloat. A single tech disruption could inadvertently squeeze Main Street totally dry. Which naturally leads us into part 4, red flags and structural risks.
Unsurprisingly, regulators in Washington are definitely taking notice. Senator Elizabeth Warren recently sent Musk a formal 13-question letter. She is warning of severe consequences if this new financial platform is managed in the same unpredictable manner as the social media side of X. Her letter specifically highlights potential risks to everyday consumers, threats to national security, and the overarching instability of the entire financial system if billions of dollars aren't properly safeguarded.
And that brings up a really crucial piece of the puzzle. X is actually not a bank itself. They don't have a banking charter. Instead, the app relies on a partner institution called Cross River Bank to actually hold your deposits and provide that essential up to $250,000 in FDIC insurance. So X is just the digital storefront, Cross River is the actual vault.
Now, this specific partner bank raises some immediate concerns. Cross River Bank was hit by federal regulators for unsafe practices back in 2018, and then they were hit again for unsafe and unsound practices as recently as 2023. This is especially worrying right now, given that federal financial watchdog budgets have recently been gutted. That means there are fewer eyes monitoring these exact types of third-party partnerships.
You also face unique structural risks with third-party apps. Think of it like the plumbing in the middle. Even if the partner bank is completely FDIC insured, that insurance only kicks in if the bank itself actually fails. It does absolutely nothing if the technological plumbing in the middle just freezes up. We saw this exact nightmare scenario recently with a financial app called Yada, where a massive tech breakdown locked users out of their real savings for months. People were unable to pay rent or buy groceries despite their funds technically being totally safe in a partner bank.
But you know what the ultimate twist is here? Despite all this hype and the massive disruption it promises, you literally couldn't move your money there today even if you wanted to. As of right now, X Money remains in a very limited external beta testing phase. There is currently no official public launch date announced.
So, the biggest takeaway from this explainer is that this whole story should really be a wake-up call for how you manage your own finances. You absolutely do not need a billionaire's middleman app to escape those terrible legacy bank yields. Standard high-yield online accounts and government-backed treasury bills already offer highly competitive rates between 4% and 5% today, complete with established customer service and direct security.
So I'm going to leave you with this final thought to chew on. Take a hard look at the interest rate you're earning today. Are you going to let customer inertia just silently drain your wealth, or is it finally time to take action and make your money work for you?